Hi, I'm Tom Lydon, editor of ETF Trends, here in Hollywood, Florida at the ETF.com conference. And I'm here with Jerome Schneider, who's head of fixed income, short-term fixed income at PIMCO. Jerome, it's great to see you.
Thanks very much, Tom. Appreciate to be here in Hollywood.
So it's a great conference, a lot's going on, but one of the main topics is what's the average advisor looking at as far as fixed income allocation here in 2015?
Obviously at the conference we're thinking about ETFs. The average fixed income investor and advisor is thinking about ETF allocations typically in the equity side, but the fixed income side of ETFs is really one that's become very poignant, especially over the past few years. Fixed income has become a hot topic over the last few quarters, as we anticipated higher rates. And advisors have adjusted their portfolios in anticipation of higher rates and really have shortened durations and taken active approaches in terms of managing interest rate risk. What we really need to think about is that there's countervailing trends that are forthcoming in the marketplace.
Yeah, it's really been kind of smooth sailing for a long period of time, but kind of your thought is winds might start picking up, is that right?
Yeah, well, we've had a lot of warm trade winds over the past few years. We've had quantitative easing here in the US, we obviously have it around the world with Japan and the ECB and the Eurozone, but that's going to change, and what we're really going to have is, again, these countervailing trends, these macroeconomic forces that are going to create cross currents. So the balloons that have been lofted up high in the air and supported with yields and positive total returns over the past few years, they're going to experience a little bit of volatility, and advisors need to be thinking about how to create diversified portfolios to really subdue that volatility profile. And in doing so, they're going to have to be thinking about active ways to adjust their portfolios and not necessarily getting rid of a fixed income allocation, but thinking about ways to create a diversified set of portfolios with a fixed income allocation in it.
Yeah, so part of what we chatted about earlier before we got going is, you look at the Barclays Ag and it's really served people pretty well for a long period of time. But portions in the fixed income asset classes may very much be challenged, while others might have great opportunities.
So one of the big concerns we have, and I have specifically as a short-term manager, is investors have obviously reduced their exposure to higher volatility structures, higher volatility risks over the past few years. As an advisor, you want to do that. You want to give your clients a smooth ride. My job as a portfolio manager is to do the same. So I want to de-accentuate high risk, highly volatile issues within a portfolio structure. So for us, we're de-accentuating interest rate risk and allocations, but there's still ways in fixed income to garner positive carry and positive income. So we want to accentuate credit and other sources of high quality carry within the portfolio. Long story said is you can still produce positive alpha, positive excess returns, and for your clients by accentuating other risk attributes, but you need to do so in a diversified way. What we've seen over the past few years is investors, portfolio allocators, look to create and reduce that risk by simply moving in from long duration core bond strategies to a shorter duration profile, call it 1 to 2 years. Yeah. And typically those have been done over the past few quarters in passive index benchmark strategies. Yeah. Our concern really in 2015 is that is the most dangerous place to be. That's the eye of the storm. You don't want to sail your hot air balloon that's used to going in favorable trade winds right into that rate hikes that the Fed's going to probably have during the course of 2015. So how do you do that? You really need to think actively. Think about accentuating across different risk attributes, and most importantly, thinking about ways to find value, better risk reward profiles to help buffet against the volatility we're going to see in the broader marketplace, not just in fixed income, but risk assets in general.
So as an example, a lot of advisors had a good chunk in treasuries. Just shortening the duration doesn't mean that it's not risky.
Oh, of course. What you think is a safe asset class simply actually becomes very much a capital at risk trade. When the Fed starts to hike, what's the first thing that happens?
Treasuries.
Well, treasuries get repriced immediately. Right. And the part of the treasury curve that gets repriced is the very front end. So the riskiest place you can actually be is the short-term space. I become from the safest point of view on the yield curve to the most risky over the course of 2015 as the Fed starts to think about tightening credit. So what do? You need to be thinking about not necessarily just de-emphasizing, but where on the yield curve you're going to take interest rate risk, if at all. But this is simply a story of not getting out of fixed income. It's actually getting a story of how you allocate fixed income and being active in that approach.
Great point. So Mint, M-I-N-T, which you've been managing for a while and now has a 5-year track record, you're implementing a lot of these strategies that we're talking about right now, right?
Exactly. At PIMCO, we've been in the actively managed ETF fixed income space for more than 5 years. Mint was the starting, where it's right now the largest actively managed ETF. We have a long-standing track record of positive alpha over the past few years. The most important thing is it has offered and continue to offer changing and gradual approaches to the evolution in the market, whether it's through macroeconomics or whether it's through simply economic data. And in doing so, we're able to sidestep higher volatility, lower return situations and accept higher return situations that create, frankly, a more diversified, lower volatility profile for clients. All that being said, is as you approach the changing dynamics over the course of the next year or two, with everything going on in the world, the changing macroeconomic trends is going to really force investors to take an easy approach. You need to have a macroeconomic thesis, number one, and number two, an investment philosophy which allows you to adapt actively to this. So we've done this at PIMCO for the past 5 years. In addition, we've broadened our suite of products over the past year and a half. Obviously we have Bond, the actively managed ETF, and we launched a low duration ETF, ELDR, over the course of the past
ELDR.
LDUR.
LDUR,
yeah.
Okay.
And it had tremendous returns. It was number one in its peer group over the previous year. So for us, the continuing focus on actively managed ETFs is simply a subset, an important subset of what we do at PIMCO in terms of our actively managed fixed income franchise.
Jerome, thanks for spending time with us. We appreciate it.
Absolutely. Thanks for the opportunity.
Good seeing you.